When I sell my properties, I'll have to pay a crap ton in capital gains tax. Ouch. Spend many a nights thinking, how can I best maximize and build wealth? What exactly is a 31 exchange? And I hear that it can actually help you do that. Today's guest is Ricard. Ron is a certified exchange specialist, one of only about 100 in the US. He has decades of experience in navigating the complex terrain of tax deferral strategies. His deep understanding and expertise makes him the ideal guy for anyone looking to optimize and protect their capital through a 1031 exchange. He has helped countless investors defer millions in capital gains taxes, not only in US investors, but also international ones. I'm Charlie Giang, and I came to Silicon Valley from Singapore about 20 years ago to be a startup founder. Over the years, I've developed a love for Silicon Valley real estate, and I'm now a full-time realtor. Ron, thank you for joining us. I really appreciate it.
Well, thank you for having me, Charlie. I look forward to it.
So let's jump right into this. So one of the things that a lot of people want to know is that the search will come up, especially on Google, on YouTube. When people hear about 1031 exchange, they hear that you can save capital gains tax, but a lot of people don't understand the mechanics of it. So you've prepared some slides for us, and let's jump right in. You want to tell us a little bit more about IPX?
Yeah, so IPX, the Investment Property Exchange, we are actually the nation's largest intermediary. We are a national company, and locally we have offices in San Jose. But the reality is I've got clients all over the country. But our job is solely to do 1031 exchanges. That's all we do.
So you can do a 1031 exchange literally from anywhere in the world.
You can. Maybe the 1031, though, technically is U.S. real estate for U.S. real estate. Now, you can go to territories like Guam, U.S. Virgin Islands, but it's U.S. for U.S. Technically, you are allowed to do exchanges for foreign real estate, for other foreign real estate, but those are very difficult to do. In a nutshell, 1031 is you're selling investment real estate, buying another piece of investment real estate, and in doing so, you get to defer paying your taxes. So, important thing there, you are deferring taxes. It does not eliminate the taxes. So if you sell a rental house to buy a fourplex, later you sell the fourplex to buy an apartment building, now you're old and tired and sick of real estate, and you sell that apartment building, you pay taxes from the house, the fourplex, and the apartment building. You're just deferring taxes. It does not eliminate them. Yeah, I mean, there's a very common term you'll hear when it comes to exchanges, and that term is like kind. A lot of attorneys and CPAs will often refer to these as like kind exchanges, not just 1031. That term is very misleading, though, because any kind of investment or business real estate can be exchanged for any other kind. It does not have to be a yellow house on a street corner for another yellow house on the street corner. So you can sell a rental house and buy a shopping center. You can sell a farm and buy an apartment building. You can sell bare land and buy a rental condo or a shopping center, any kind of investment real estate for any other kind. Like kind goes back to many years ago when people used to do exchanges for things other than real estate. This morning, I got a phone call from a guy who literally wanted to exchange a baseball card. Because many years ago, we were able to do that. The guy wanted to sell a baseball card for a very expensive baseball card. But all personal property exchanges disappeared in 2017. Now 1031 is only about real estate. So the term like kind really isn't very relevant anymore. One thing to note very importantly is that 1031 is investment real estate. So what is not investment? Well, your primary residence, where you live, has an automatic exemption. If you're single, you get to keep $250,000 of your gain tax-free. If you're married, you get to keep $500,000 of your gain tax-free. Now, that was a lot of money, even in the Bay Area, back in 1997 when the law was put into effect. But now it's pretty common for people, especially in big cities like the Bay Area, where their gain on their primary residence is more than the $500,000, or if they're single, more than the $250,000. So the question always is, when it comes to primary residence, no, you cannot do a 1031 exchange on your primary residence, but there are options that you can do.
What kind of two options?
You got two. Yeah, so first one is, does any part of your property qualify? What's a really big trend in California right now is building ADUs. So if you have an ADU in your backyard, if you have a home office, you rent out the basement, whatever percentage of the property you're showing as investment real estate or business real estate, that percentage of the sales price you can do an exchange on. So here's an example of 20% of the house is considered to be investment. I actually just opened an exchange last week for a woman in Woodside. She has 3 ADUs on the property, so literally 50% of her entire property, her accountant was showing on the tax return as investment. So half of her sales price she was able to do an exchange on. The other half she treated as her primary residence. The reality is, though, most of us don't have home offices. We don't have ADUs or rent out any part of our house. So another strategy for highly appreciated primary residences is move out, turn your house into a rental property. After you're renting it out for a couple of years, that property is now considered to be an investment, but you still meet the definition of primary residence, because the definition of primary residence is one that you've lived in 2 of the last 5 years. And so because of that, you get to take advantage of both tax rules at the same time. So let's say your property sells for $2 million and you're married, you get to pocket $500,000 and then do an exchange on the remaining $1.5 million. So this is a great strategy for people who have a highly appreciated primary residence. They feel trapped by it because, as you said at the beginning, Charlie, they don't want to pay taxes and all that extra capital gain. So if you with enough planning, you can almost always get anything done to avoid paying taxes, but you got to plan for it.
What would be a really good way to not break the law and be able to, let's just say sell their primary home and buy 3 or 4 different rental properties and then move into assisted living and then live off the rent from that? What would be the best way to do that? I mean, if they wanted to do that.
So this is something that I do talk to a lot of people, not usually the people doing it, but their heirs. They're in their sometimes 80s or even 90s, and they move to assisted living. They need some cash flow to make it in order to be able to continue to live there. So, again, initially, yes, they need to be renting out their current property. Is that often enough to generate the income they need? Often it isn't. So that's why the idea of, renting it for a year or 2, selling it, now they get to keep that $250,000 or $500,000 exclusion, which is going to give them some cash to continue for their those living expenses. But as you said, Charlie, the best thing they could do then is take that money, buy multiple different assets that are going to create an income stream, whether it's commercial real estate or multiple properties or multiple or a multi-unit property, something that's going to generate the income they need on a monthly basis to continue their living in these assisted living or any kind of retirement community. So that's another kind of planning strategy I will often do with people's heirs, and with the expectation also that, ultimately they're going to pass away. The heirs will get will receive the property at a stepped up basis. So all the capital gains disappear out of the whole thing. So this is a great strategy to generate the income you need for your retirement years.
Oh, cool. So the heirs would usually be the one that you would be talking to, and not so much the individuals. And
Often.
they say, hey, yeah, and they would say, hey, I need my parents taken care of, and but it's difficult for me to pay for assisted living because I'm barely getting by. But they're sitting on a whole bunch of equity in their house. So the best way is to basically switch that primary home that they are into maybe two years of rental, like you say, and then at that point of time, will it make more sense to sell that piece of property and then convert 100% of it into a 1031, or is it better to take the 250 out from that and then whatever the rest of it into 1031?
Well, considering that you can keep some money cash tax-free off the top, there's really no good reason not to do that. Now, if you want to use that money to do other investments or to continue to invest with the real estate, then that's fine. But as a rule, if I could take money off the top that I know I don't have to pay tax on, I'm going to do it. You always take advantage of any free cash the government's going to give you. Just make sure people know that you can't exchange properties that you're flipping or developing, because that's not considered investment, considered to be property held for resale. Also, you can't exchange it to any kind of of partnership or syndication, anything that's not direct ownership of real estate. The last one is just kind of the one that surprises most people, second homes. Second homes do not qualify for 1031. Now, most people think, well, I don't have a second home, but they do because they're letting a family member live in the property and they're not charging them rent. So you got a kid living in a property, unless you're charging them market rate rent and collecting it, it is not considered to be an investment property. So you got to treat your kids like a regular tenant. And that's very difficult for people, especially sometimes though the people living in those properties are your parents. And to try and charge your parents market rate rent can be pretty difficult. But, the reality is if they are not being treated like a regular tenant, then in the eyes of the IRS, they view that as a property that is for the benefit of the family and therefore a second home. And therefore, once it's time to sell it, you're going to have to pay taxes on all of the gain from that property. There are two main things to know when people do an exchange: how much do you need to spend and how long do you have to do it. This is probably the most critical thing, is that in an exchange, you have a very strict timeline. From the day you close escrow, you got to know what you're going to buy within 45 days, though you have 180 days, which is almost 6 months, to close escrow. So 45 days to identify to us exactly what you are going to purchase, and 180 days to close escrow on whatever you've identified. That 45-day clock really is a critical one. Can you buy for more than $1 million? Yes. Can you buy multiple properties that add up to $1 million? Yes. Can you buy for less than $1 million? The answer is actually yes, but you pay tax on the difference. Sometimes you'll hear the term boot. Boot is what you pay tax on. So if you sell for $1 million but only buy for $900,000, that you pay tax on that incremental $100,000. I don't care what you bought the property for. I don't care how much money you spent fixing it up. I don't care what your original down payment was. None of that matters. All of that goes into your basis. All of that rolls into the replacement property. So anything you don't spend is considered to be from your profit and therefore taxable. When we talk about doing 1031 exchange, obviously the most obvious thing that comes to mind is we're doing this to defer taxes because nobody wants to pay taxes. But the reality is you don't do an exchange just to defer taxes. You do an exchange because you want something better out of your real estate than what you're currently getting. So what does better mean? Better means whatever is important to you. Better could mean better cash flow. Better might be I'm moving to Arizona, so I'm moving my rentals to Arizona. Better might be I ran out of depreciation, so I want to do an exchange into something that's going to get me more depreciation. Better might be I want to sell my 3 houses to buy a shopping center. Better might be I want to sell my shopping center to buy 3 houses. It's whatever you feel. A lot of seniors, they will do exchanges into assets that are much less management because they're tired of managing real estate. Another one I love doing is I do this often for people who are like over 85, seems to be the target number, where they will do 1031s for estate planning purposes. They don't want their kids to fight over their property, so they do exchanges. Each kid knows exactly what they're going to inherit. There's no fighting when the time comes and they inherit the property. So the reason I point this out is when you're thinking about doing an exchange, don't focus on just not paying taxes. Don't sell the property, you're not paying taxes. The reason you do the exchange is because you want to buy something better. And better is whatever better means to you. But 1031 is that magical part of the tax code that allows you to get from the real estate you own today to what you want to own tomorrow and not have to pay the tax man every time. And so that's the real beauty of the 1031. It's been around for more than 100 years as part of the tax code. And real estate is the only asset you can sell at a gain and not pay tax on. So it's a pretty special thing. Well, paying the taxes is always an option. Dying is a great tax strategy, though I never recommend that as a something you want to do proactively.
No.
Seller financing, I think is a very underutilized tool. Seller financing, you act as the bank. So someone puts 20% down or whatever you negotiate, and you get payments every month.
Well, Ron, thank you so much for being on my show today. I really appreciate it, and I think the information will be of very good use to a lot of people out there, and for the slides. Again, if anybody wants to know more about 1031 exchange, you can either contact me or Ron. His contact information will be in the description down below. Thank you so much, Ron. I really appreciate you coming on.
All right, Jerry. Great having you.